Hello again, this is Dr. Lindsay. And in this video, we're going to be talking about stabilization with monetary policy. So just a quick review, fiscal policy is from changing spending, government spending, and taxes, done by the politicians, Congress and the president. And it works because we say, well, aggregate demand is C plus I plus G plus exports minus imports. And by changing G and T, that will change the components of aggregate demand, consumption, and government spending, and change aggregate demand. Monetary policy is changing the money supply. That's done by the Federal Reserve. The politicians don't have any control over that, except that they do have a say in who gets to be on the Federal Reserve. The president picks somebody, and then it's approved by the Congress. Federal Reserve does have to report to Congress regularly and tell them what's going on. It's Congress that gives them their charter to print money. But they're somewhat independent on what the economists or what the politicians think they should do for the economy. Not that they're not influenced heavily by the politicians. The politicians would like to influence them even more, but they are limited in how much they can do because they have some rather long terms on the Federal Reserve, the Federal Open Market Committee. Monetary policy, again, can be looked at in terms of aggregate demand, and that somehow or another, changing the money supply affects aggregate demand in this model. So aggregate demand is C plus I plus G plus exports minus imports. Somehow increasing the money supply does something to C plus I plus G and increases aggregate demand. Decreasing the money supply, once again, somehow affects C plus I plus G and decreases aggregate demand. Monetary policy does work. It's pretty much agreed upon by economists that without a doubt it works. What isn't agreed upon is how it works. And we could go through a number of different ways as to how changing the money supply might affect the economy. But the traditional view here is it affects aggregate demand, and probably by interest rates. We'll go through that. And interest rates seem to affect consumption spending and investment spending. Now, the Federal Reserve they can have a policy where they're being expansionary, trying to expand the economy, or contractionary, or maybe a neutral policy. And we refer to this as the stances of monetary policy. How is the FOMC thinking today about the economy? Are they being expansionary or contractionary? So contractionary policy, remember, is contracting the money supply, bringing the money supply down. Expansionary policy is increasing the money supply. And the term for contractionary monetary policy is a tight monetary policy, whereas expansionary monetary policy is usually referred to as accommodative. 2 C's, 2 M's. That's the most current word that's being used for expansionary monetary policy. The Fed will say they're being accommodative. Another term is loose policy or easy monetary policy. Those aren't used so much anymore. And a neutral stance is they're not trying to expand it or contract it. They like it just where it is. Now, contractionary monetary policy contracts the economy. And expansionary monetary policy stimulates the economy. Now, which of those policies do you think politicians would prefer the Federal Reserve have? Of course, they prefer them to have an expansionary policy, an accommodative policy stance that will stimulate the economy. No politician gets elected or reelected during a recession. So they want to keep the economy going. So why not? Why not just always expand the economy all the time? Just always have an expansionary monetary policy. Do what we can to kick the economy. Who doesn't want a better economy? Well, the problem is inflation. An expansionary monetary policy causes inflation. It takes a little time for that to happen. Maybe the politicians are out of office by the time that happens. Contractionary policy is not used very often. The main reason why a central bank like the Federal Reserve would pursue a contractionary policy is because inflation is too high. And if they deem inflation is too high, then they will move to a contractionary economy. If they don't think inflation is too high, or is not going to be too high in the future, then they're reluctant to try to pursue a contractionary policy. It's difficult to know what the current stance is of the central bank. You may think it'd be really easy, just look at the money supply, is it increasing or decreasing, but it's not that simple at all. It's difficult for even central banks to know what their stance is and get it right. During the 1970s, monetary policy was very loose, accommodative. There was a lot of inflation. Our Federal Reserve actually thought they were pursuing a contractionary policy. They got it wrong. So they don't always know which policy they are actually pursuing. They know which one they're trying to pursue, but they don't always get it right. And there's a number of different measures to try to figure out whether they're neutral, expansionary, or contractionary. It's not that simple, and it really hasn't been worked out yet completely. And it's beyond the scope of this class. Okay, now let's take a look at monetary policy in the short run. We use the Keynesian macroeconomic model, aggregate demand, aggregate supply. We've got some equilibrium here. We'll call it pi superscript, the asterisk star, and output y star. Now suppose the Fed decreases the money supply. It will lead to a decrease in aggregate demand, a tight policy, contractionary policy. It'll shift that aggregate demand curve to the left. Here's the money supply dropping. And we'll have a new equilibrium. And you can see in the short run, GDP will fall. And according to this model, inflation will fall. So Y falls and inflation falls. And this graph makes it look like they're happening at the same time. That may not be the case. Output seems to adjust very quickly, up or down. Inflation and prices, especially inflation, seem to adjust slowly, not at the same time. So output might drop quickly in the next few months, but it may take a few years before we see the change in inflation. How does it work? Well, we know it changes aggregate demand in the context of this model, but exactly how would decrease in the money supply change aggregate demand with a C plus I plus G? Aggregate demand is C plus I plus G plus exports minus imports. Exactly how does changing the money supply affect the C plus I plus G? Well, a drop in the money supply increases interest rates, nominal interest rates. So remember the money supply, money demand graph. We've got this demand for money, supply of money, and an equilibrium interest rate. And if the money supply decreases, a shift to the left we would have a new equilibrium at a higher interest rate. So changing the money supply affects interest rates. Decrease it, and interest rates go up. Increase the money supply, interest rates come down. So the traditional thinking here, and this was originated by Keynes, is that if interest rates go up, it's harder for people to buy things because it's more expensive to borrow money. It's more expensive to buy a house because now you have to pay a higher interest rate on that house. Most people, when they buy a house, they borrow the money. The higher the interest rate that you have to borrow it for means the monthly payments are higher. The higher the monthly payment, price goes up, quantity demand goes down. It's more expensive. Or people can't qualify for a loan when the payments are high. So interest rates go up, they can't buy a house, it's more expensive to buy a car, it's more expensive to borrow money for anything. So as a result, consumption goes down. Investment goes down. Aggregate demand decreases. There may be some other ways that this works. This is called the monetary transmission mechanism, and that is how does a change in the money supply actually affect aggregate demand in the economy? We could go through a dozen different ways as to how it might work, but that's outside the scope of this class. That's really for a money and banking class. So we go through a dozen different ways as to how it might work. Maybe more than one work, maybe none of them work. It's really hard to say. It's just not agreed upon or well understood just how the money affects the economy. But it affects it without a doubt. It stimulates it or it contracts it. What about in the long run? Well, if we're going to figure out what happens in the long run with monetary policy, we need the long run model. And the long run model, we use the long run aggregate supply curve. The long run model, aggregate supply is vertical at potential, because our equilibrium in the long run is always at potential GDP, right on the edge of the PPF. The vertical axis is inflation. So decreasing the money supply, increasing interest rates, changing aggregate demand curve shifts to the left. In the long run, what's the result? A lower inflation rate. So in long run, decreasing the money supply has no effect on output. No effect on real GDP or real output. It only lowers the inflation rate. So only lowers the inflation rate. Which makes sense. Decreasing the money supply and prices coming down. Increasing the money supply, we're going to have more inflation. So the inflation rate will go up if we increase the money supply. But no change to potential output. So remember here on the PPF, in the long run, we're going to be right here on the edge of the PPF. What changes in the money supply will move the economy to a different position, but it won't change potential output. So in other words, if we're inside the PPF here, maybe we're in a recession, increases in the money supply will stimulate the economy and will move the economy out towards potential. But it won't change potential. It'll just change where we are in relation to potential. And that's because potential output YP, or where the PPF is a function, is a production function. It's a function of a whole bunch of different things. How many people we have, how much technology we have, how much human capital, how much capital. It's a function of those things. And the amount of money that's printed is not in that production function. The amount of money does not determine how much we produce in this country. It's our technology and our people and our productivity. Money can stimulate the economy or contract it, but all it's doing is moving us around in relation to where potential output is. I mean, too much money, lots of money can stimulate the economy and push us actually outside the PPF. That's quite possible. Not sustainable, because in the long run, we'll be back to on the PPF. So remember, this money supply changes aggregate demand, it changes output, expands or contracts the economy, leads to a change in prices, mainly in the long run, maybe not so much in the short run, but definitely in the long run. The only effect, the only real effect here, I mean, there's no real effect on the economy. The only effect is higher prices, by increasing the money supply. But it doesn't change potential GDP. It doesn't change the PPF. Okay, next I want to go over this money neutrality again, little review. So money neutrality means that money only affects prices. Money only changes prices. It doesn't affect real GDP. So not real GDP or unemployment. Or real prices or real interest rates. It only affects nominal interest rates and nominal prices, nominal GDP. The pre-Keynesian thinking on money neutrality was that money was neutral. That it really didn't matter how much money there was in the economy. More money just meant higher prices, less money meant lower prices, but it certainly didn't expand or contract the economy. Therefore, there was no point in changing the money supply to stabilize the economy. And when the Federal Reserve was created, economists didn't think that the Federal Reserve had that power to stimulate or contract the economy. That was discovered later. So the pre-Keynesian was as neutral. What do Keynes think, or what do economists think now? Well, we divide it up in the short run and the long run. Say, is money neutral in the short run? Or does money neutrality hold in the short run or not? And is money neutral in the long run, or money neutrality holds in the long run or not? So current thinking by economists is money is not neutral in the short run. And that's been shown over and over again. It is not neutral. Changes in the money supply will affect the economy. It very definitely can stimulate the economy. It very definitely can cause a depression if it's contracted too much, too fast. What about in the long run? Is money neutral? The thinking, current thinking, is that in the very long run, that money is neutral. But I think it depends on just how long we're looking at. because it certainly could affect the economy for quite some time. So the thinking here, money is neutral in the long run, or money neutrality holds in the long run, meaning that in the long run, we're going to be on the edge of the PPF, regardless of how much money is printed. In the long run, we're going to be at potential output, no matter how much money is printed. The only difference is the inflation rates. Prices will be higher, and the inflation rate will be higher with the more money that's created. So now, which policy is better for stabilization? Fiscal policy and monetary policy. There was a big debate about it at one time in the 70s. Monetary policy won out. Without a doubt, monetary policy works out better for stabilization than fiscal policy. Fiscal policy can take a long time for the politicians to act. A lot of disagreements over how much to spend, who gets it, how much to tax, where is the tax. And you have to have all of Congress agree. And they generally don't agree unless there's a real emergency going on. They can act quickly if they want to. And they've acted pretty good in the last few recessions. The pandemic recession, getting money out quickly to people that they can spend it themselves was amazing. How fast they acted, and it was actually a pretty good move. Monetary policy just works out better because it's just the Federal Open Market Committee. It can easily make decisions. They can have they meet every 6 weeks, but they can have a phone call tonight and change their policy tonight if they want to, and start implementing it tomorrow morning with their traders at the New York Fed, changing the money supply. And it seems to act very quickly too. Very easy, very quick. And so for the most part, our main tool of stabilization in this country, most other countries, is through monetary policy. And once again, fiscal policy seems to work. The question is, how much effect does it have? And really, what are the long-run consequences of fiscal policy and borrowing a lot of money? Not to say fiscal policy isn't used. It is used occasionally, mainly just during bad recessions.